The opening range breakout, commonly known as ORB, is a powerful intraday trading strategy that capitalizes on the initial market movements right after the NYSE opens at 9:30 a.m. Eastern Time, leveraging the volatility from the first few candles to establish directional bias. This strategy specifically focuses on the price action immediately following the market open, typically within the first 30 to 60 minutes, where the opening range is formed using the high and low of those initial candles on a 5-minute chart. The core idea behind ORB is to identify and mark the high and low prices established during this initial period, which forms the opening range, often visualized as a box around the first few candles after 9:30 a.m. Eastern Time. Once the opening range is clearly established after the first few candles, traders actively look for a decisive price breakout above the opening range high, known as ORH, or below the opening range low, ORL, to signal potential trade direction. A confirmed breakout above the opening range high with a strong bullish candle signals a potential long entry for buying, while a break below the opening range low with bearish displacement suggests a short entry for selling positions. The user-provided video effectively demonstrates how to visually identify these opening ranges on candlestick charts and spot the potential entry points for breakouts during the NYSE session open. Validating these ORB entries is absolutely crucial, often by checking confirmation from higher time frames, such as the 15-minute or 30-minute charts, where the opening range might appear wider or differently structured compared to the 5-minute view. To enhance setup quality, integrating smart money concepts like order blocks, which are areas of institutional interest, and fair value gaps, representing inefficiencies in price, provides additional confluence for high-probability ORB trades. The user's video further illustrates practical ways to combine the ORB strategy with these smart money concepts, overlaying order blocks and fair value gaps on the charts to refine and validate trading decisions effectively. However, day traders must remain wary of common pitfalls like false breakouts, where price briefly exceeds the range but reverses, potentially leading to significant losses if not properly filtered. A false breakout specifically occurs when price briefly moves beyond the opening range with a long wick but fails to sustain the momentum, quickly reversing direction as evidenced by the candle body closing back inside or opposite the range. To filter out these invalid trades, understanding overall market structure shifts and external premium/discount array levels, such as swing highs/lows or previous session extremes, can provide critical context for ORB validation. The user's video offers practical chart examples of identifying false breakouts versus valid ones, using labels like valid for displacement closes beyond the range and invalid for wick traps to improve risk management. The ORB strategy proves highly adaptable and can be successfully applied across various markets, including stocks like individual equities, Forex currency pairs, and indices such as ES or NQ futures. Its true effectiveness stems from capturing early directional bias in the trading session, providing traders with clear entry points on breakouts, retests, or second breakouts, along with defined profit targets and stop-loss levels. By thoroughly mastering the ORB strategy, including its validations and pitfalls, day traders can significantly enhance their decision-making process and elevate their overall trading performance and consistency. Always prioritize proper risk management principles, such as defined stop losses below the range, and commit to continuously refining your understanding of market dynamics through practice and review. Ultimately, the ORB strategy, when applied diligently with time-frame confirmations, smart money confluence, and awareness of false setups, becomes a reliable cornerstone of any successful intraday trading plan.